With K-pop Demon Hunters racking up 325 million views as Netflix's most watched content ever, why did the stock plunge 6.5% after earnings? More importantly, if you're holding Netflix shares right now, should you be selling? Netflix has been dominating the headlines recently. Their original blockbuster film, K-pop Demon Hunters, actually became the platform's most watched content in history. Logic suggests earnings should have exploded, right? Well, the results shocked everyone. Netflix released their third quarter earnings report, and shares immediately dropped 6.5%. The core issue points directly to profit margins falling below expectations, and management's guidance for the next quarter looks concerning. If you're holding Netflix stock, you're probably asking yourself what in the world is happening. Is it time to exit your position? Today, we'll be analyzing the hidden costs behind Netflix's earnings report, their transformation strategy, and 3 critical risks facing the company. By the end of this video, you'll understand exactly how to approach investment decisions for this streaming giant that's trading at 50 times earnings. Netflix's third quarter earnings report actually tells 2 completely different stories. Revenue performance looks spectacular. Driven by blockbuster content like Demon Hunters, third quarter total revenue grew 17% year over year, showing you how it's done. User growth, price increases, and advertising revenue all contributed positively. However, one massive fine absolutely devastated profits. The critical problem in Q3 earnings is earnings per share of just $5.87, missing expectations by $1.09. The issue was, Netflix had to pay Brazilian tax authorities a one-time settlement of $619 million. This charge hit their operating costs directly and really stung. Without this charge, Netflix's earnings per share would have reached $7.30, which would have significantly beaten expectations. The fourth quarter guidance deserves even more attention. Management projects Q4 revenue growth remaining at the same level of 17%, similar to Q3, but operating profit margin dropping to approximately 23.9%, which is lower than the previous 3 quarters. There are 3 factors that explain this decline. First, amortization expenses for popular content begin accruing. Second, Netflix is increasing investment in both advertising infrastructure and their gaming business. Third, with the holiday season approaching, marketing spending increases. Netflix's performance includes seasonal patterns. The company typically boosts marketing spending in quarter 4. The fourth quarter content pipeline remains strong, featuring Stranger Things, Season 5 finale, The Diplomat, and NFL Christmas Day games expected to attract substantial audiences. These actions reveal Netflix's transformation from a pure subscription company to one aggressively funding 2 new businesses, advertising and gaming. The critical question becomes whether this transformation strategy will actually succeed. Let's examine Netflix's approach to transforming their business. Beyond short-term earnings volatility, Netflix stands at a major transformation crossroads. Their objective is building a robust advertising business system using 3 strategic advantages. The first trump card is their high-margin advertising revenue. Netflix's transformation timing is excellent. Advertising revenue diversifies their income streams and reduces their dependence on subscriptions. More importantly, this revenue generates higher profit margins because it requires no additional content costs. This significantly boosts overall company profitability. The second trump card is their AI-optimized recommendation algorithms. Netflix's ACE remains its 300 million user base and massive data reservoir. Approximately 80% of viewing behavior originates from their recommendation systems. Netflix is expanding AI applications, focusing not on generating AI content, but optimizing those recommendation algorithms. Algorithm upgrades increase user watch time while making advertising targeting more precise and efficient. The third trump card is their content moat. Netflix possesses enormous content advantages, creating a powerful moat far superior to direct competitors like Hulu and Disney. The company has for now dodged acquisition rumors involving high-debt businesses like Warner Bros. Discovery, which is positive for long-term financial health. Even with these 3 advantages, Netflix faces one formidable competitor. This competitor actually commands a larger user share than Netflix and continues growing. It's not Disney or Apple. Before we reveal the true king of streaming, be sure to give this video a like. Netflix confronts 3 major risks, with the biggest threat surprisingly coming from YouTube rather than Disney. First up is a major competitive risk that comes from YouTube harvesting attention. As of June 2025, Netflix's share of US television watch time stabilized around 8%. YouTube not only commands a larger share approaching 13%, but it also continues to grow consistently every single quarter. This signals extreme danger. Although content overlap remains low, with Netflix focusing on films and series while YouTube offers user-generated content, both compete directly for audience attention and advertising revenue. This competitive dynamic suggests YouTube, not Netflix, may dominate future entertainment experiences. Next, let's talk about political risk and the boycott shadows. The recent Cancel Netflix movement exposed the company's vulnerability. Taking strong liberal positions on sensitive issues triggered conservative viewer backlash, gaining support from prominent figures like Elon Musk and causing multi-day stock declines. In today's polarized political environment, Netflix has to navigate carefully or risk massive user churn. Finally, we have the regulatory risk from looming massive fines. Brazil's $619 million fine demonstrates how unforeseen regulatory obstacles can impact global platforms. As the advertising business expands, Netflix faces increasing data privacy scrutiny and potential additional penalties. Do you prefer YouTube's user-generated content model or Netflix's high-cost original content approach? Let us know your thoughts in the comments. Next, let's calculate whether Netflix's 50 times price-to-earnings ratio justifies its current valuation. Our analysts project Netflix's future earnings growth will exceed the 15 to 16% revenue growth driven by their high-margin advertising business. Earnings per share should maintain an 18 to 20% growth rate. Pay close attention to this. Although 18 to 20% growth appears attractive, it may not fully support a current valuation above 50 times earnings. This explains the recent lackluster stock price performance. Netflix is experiencing a transformation from quantitative growth to qualitative growth. Their content moat, user scale, and advertising ambitions represent positive factors. However, the company faces tough competition from YouTube, political risks, and high valuation challenges. Netflix remains an excellent company, but the current pricing incorporates all the most optimistic expectations. Facing this high valuation, investors should maintain caution. Unless the advertising and AI algorithm progress delivers better than expected profit margin improvements, sustaining that 50 times PE becomes difficult. Short-term profit margin pressure results inevitably from increased investment. Netflix remains the industry leader, but shares may need time to digest those investment costs and that high valuation. Do you believe this high valuation growth stock will continue rising? Let us know what you think. Down below. If you found this Netflix analysis helpful, be sure to give this video a like and share this with a friend who might need Dalio's advice. Subscribe to Trading Key, hit that notification bell, and we'll see you in the next video.